Hi everyone, today's title is Risk 50 and Reward 100 Above. This is Nikki, also known as Faces Trader, and you're watching the Awesome 10X Free Friday class. This always happens every Friday where I discuss Awesome 10X global market updates. So let's begin. And I do want to share tomorrow's event. It's going to be a face to face seminar for everyone who wants to meet me and also to join a 1 month Awesome 10X Inner Circle subscription for everyday knowledge on the markets. Let's take a look at that. Let me also present by sharing my screen. Okay. So guys, you're in for a treat today. When I say risk 50 and reward 100 above, I do expect you guys to understand that I'm talking about $50 here. So this isn't pesos. So we are trading the global market. So we are trading USD. So we're going to be explaining the mathematical system of lottery calls and put options for event-driven trading. So today's category is stock options trading. Don't worry, it might bleed you if you are not necessarily understanding of what calls and puts are, but I expect you guys to understand this after an hour. So let's begin. Tomorrow, I will be discussing how do you save your finances and how do you profit from market crashes in this worldwide recession. Tomorrow is on November 26, 2022, 9 a.m. in the morning until 12 noon. That will be 3 hours. It's going to be at Three Squares Bar Cafe, Caravan Plaza, Makati. You can register now, http://bit.ly/awesome10x inner circle. Of course, you can just join in and go in and attend. For those who are Awesome 10X members, it's all for free. For those who are non-members, though, you do have to pay 3,000 pesos for that event. And of course, we'll give you a 1 month monthly subscription on account of your attendance. Of course, you can also just message Rach Diaz. Her mobile number is 0917. It's going to be 5318949. You can just message her if you want to attend. And of course, we do expect to teach you everything from the start to finish on how to open your global market account if you haven't opened your account, if you're a beginner, etc. So one thing to explain today's class is number one, to enter into any risk setup, trade and trade ideas. Number one, you need to have a defined event. What is it, that event that you are trading upon? Is it a potential earnings? Is it a potential Fed rate event? Is it a Fed pivot, Fed cut, whatsoever? But you need to define an economic event. Number two, you need to define what it is that you are trading upon. Is it a long or a short? And you want to define your risk to at most 0.1% of the portfolio, because we're talking about options here, or you're talking about an absolute number. So it could be like a $50 or $100 or $200. It has to be an absolute dollar size or a percentage of your portfolio. Typically in options, at about 0.1%, because in options, you do expect decay to happen. Okay, so for those who don't understand what decay means, I'll explain that overall in the options trading later on. Of course, you need to execute it with the right expiry date, and we'll also discuss why that expiry date matters. And then, of course, once you finish all those risk management of absolute number, right expiry, which put option to indicate, you do have to rinse and repeat those trades over and over again, such that you will earn your size by building consistent wins over many months until proven. Of course, you never size up until consistent. You may be winning $100 back and forth, but without consistency, that would be nothing. So you could be earning $1,000 and yet blow it up on the next trade. The basic concept that I will discuss to you guys is number one, you want to pay a 3% yield or less for a put option that is theoretically 15% lower for the strike price rather than the current price. So for those who aren't aware, let me just define a few things here. A put option allows you to sell a position at that strike price. The strike price, when we say 15% lower, for instance, your current price is 100. When we say 15% lower, it's $85, meaning you are bearish the market in this case, because we are trying to teach you how to save your finances from a potential market crash or a worldwide recession. Our viewpoint is that your event here is a 10-year or a 5-year or a 1-year crisis that would last for a longer time than expected. So that means whether it be a 3-month option, a 6-month option, in this case, we're trying to look for an April to June 2023, which means around 4 to 6 months expiry, 4 to 6 to 7 month time frame expiry. And if you know how options are basically valued upon, they are valued between intrinsic value and extrinsic value. You should be aware of what theta means, which is time decay. The more time it takes for a stock to fall down, you obviously have to pay more for that time. So it makes sense that you want to pay for a yield. It's not necessarily going to be zero, but you want to pay it at least a small amount as much as possible. So we want you to pay a 3% yield or less. So it could be 1% yield, 2% yield, and so on for a later expiry like April to June. Now, when it comes to earnings beats, we do want you to short, obviously, a position with more misses, more guidelines, or even if they make a beat, as long as they have a low guidance, then we suggest to own puts on them. So, for instance, we will highlight insider selling as well on certain tables. For instance, Walmart here, as an example, passes the short test. So, for instance, on the June 2023 Walmart puts at 135 strike, even at $4, it's still cheap. And of course, if you could buy it at $3, which seems that you are able to do so, it is better off. Now, some of the big earnings beats this week, such as the Burlington, Abercrombie and Fitch, and American Eagle Outfitters, given they popped 20% on their earnings after hours, helps in potentially getting their puts 50 to 80% lower. So we are anticipating for that earnings guidance to continue the stock going up, but we want to anticipate a cheap entry on the put options for these types of good earnings pops. So these are an example of a table that I've created for many Awesome 10X members that I'm also sharing to you. Of course, the current price of puts here have been moving, but I just want to explain to you how this table works. You usually have a stock price. Of course, the stock price would move. And then you want to enter into a strike price wherein you want to have an out of the money put option. So the out of the money put option, it tells you that these are the percentages away from the price. So you're expecting, for instance, Kohl's department store from $32 to potentially hit 30 or lower. So you are going to have to make a put option with as much as possible a 3% yield. So you'll notice that 3% of 30 is 0.9, and you want to bid it as much as possible $1 or less. So there are times that you could probably bid 60 cents, 39 cents, etc. But you have to also compare that with the current price of the put. So for instance, here, you can already see that Burlington, Best Buy, ASO, which hasn't reported earnings yet, Abercrombie and Fitch, Macy's, American Eagle Outfitters, most of them are trading between 8 to 15%, which means that it is nowhere in our buy zone yet. And we need to wait for a crush either in Vega or Theta. Vega means volatility, Theta means time. Now, we know that as we near this June expiry or April 21, 2023 expiry, the Theta will go down as it is, but the yields would not necessarily fall if the stock price continues to go up and up and up. So obviously, you need to wait out for the put options would go down if and only if the stock price goes up. So you want to wait for the stock price to go up and meet the rejection resistance in order for your yields here to go down to 3% or less. And obviously, once you get your yield, now you wait for those strike prices to get done over the next 5 months, 4 months, etc. So the more misses, as we said, the better. Take note that Kohl's department store and Nordstrom already made an earnings report and they have already missed their expectation, which means that their earnings move, although down 1% and down 9%, gives us more conviction on selling calls in GWN, and it's only a matter of time that we want to enter the puts at a lower price. Take note also on the percentage from 52-week high to help you in assessing how far and how much resistances there are into the stock. Obviously, the higher it is within the 52-week high, the less pressure. So you can actually see that TJ Maxx here in Walmart has lower yields because they're also near their 52-week highs. And sometimes you get lucky wherein there's a miss in earnings here and an earnings move down. You've got a percentage of 52-week high here and sometimes even a beat. And that gives you more instances to potentially sell it upon resistances. So here, Best Buy and Burlington. I think this one is more clear to you if I go through the charts. So for now, let me explain to you how things work. Number one thing that you want to do when you're executing a risk 50 reward 100 above is to understand how it works. You have a stock price, you have an earnings move, and you have the earnings either beating estimates or missing estimates. And then you take a look at the 52-week high and the percentage of the stock versus the 52-week high. The more it is farther away from 52-week high, it means that there are more resistances, which when it has a beat, makes it easier for the stock to fall down after it rallies. Now, obviously, the more insiders selling, the better. So in this case, you could see that amongst those companies that beat, there is insider selling in Gap and Macy's. There hasn't been insider selling yet on American Eagle Outfitters or Abercrombie and Fitch, which means that you want to sell American Eagle and American Eagle Outfitters and Abercrombie and Fitch if and only if the insider selling already starts selling with you. You generally want insiders to be selling when you are shorting so that it has more pressure and more resistances. Same thing for here, Best Buy. Same thing for here, Nike. Now, take a look as well on the companies that made the beat. There are companies that are beating numbers with an earnings move of greater than 10%. Here, it's 12% up. Here, for Nike, it's 12% down because it missed. But you generally want to take a look that even if it's beating, if the insiders are selling en masse, in this case, Walmart and TJ Maxx, despite hitting near all-time highs, is actually getting met with a lot of insider selling. You do have to watch out for that because it may be giving you very cheap put options that gives you a chance to sell near the utmost high of the companies. Okay, so let's give you a few examples here. There are also some signs of indicators that are quite reliable. We've seen that some insiders, particularly Congress or senators, have been able to top tick a certain name. So for instance, Nancy Pelosi, one of the trackers here for NVIDIA, tells you that she sells near the top. So NVIDIA here at about $190 seem to also have a nearby 200-day moving average. Now, for those who aren't basically using technicals, for those who love to short stocks, you do have to take into consideration that many companies, whenever they reach 200-day moving average, sometimes tends to overshoot, but eventually always manages to go below it. So you'll notice that NVIDIA here from March till about November has always been trading below the 200-day moving average, which is trading here at $240. So although NVIDIA can rally from here 165 towards 190 or 240, the chances for it to really break above 240 is little, not unless the earnings continues to be beating estimates. Now, we also know that most of the companies from NVIDIA to Qualcomm to AMD, the sector is actually declining in sales. So it makes us more conviction to enter into a put on these types of names. NVIDIA is on a downtrend, AMD is on a downtrend. How do you actually capitalize on downtrending stocks within a sector as well as their inverse funds? In the semiconductor space, there is such a thing as a complex inverse fund, which is 3x shares here. What Semiconductor Bear does is they're actually shorting NVIDIA, Qualcomm, AMD, and all the likes in a triple leverage fashion. Meaning, even if AMD is up 1%, and NVIDIA is up 3%. As a sector, if the entire sector is going up 3%, the semiconductor bear should be expected to go down 3 times 3 or 9%. At the same time, if it's down 3% here, there are several ways to notice that other than this is at current support, you want to actually see, all right, the semiconductor bears look to be at support. If I want to short NVIDIA and AMD, how else do I handle this with just a limited risk of $50 or $100? So this is one way to actually execute that. This is an ETF that is triple levered. So here's how you do it. The semiconductor shorts today is trading at $32. You're seeing it at $32. If you're bearish the market and you think that NVIDIA and AMD will go down from their current resistance areas here, that you are nearing the tops at 90 for AMD, that you are nearing the tops at 200 for NVIDIA, what you can actually do is potentially assume that if you want to buy a bearish idea here, there are several ways. If you buy 100 shares here on semiconductor SOX today at 32, you will be spending $3,200. And let's say you will cut that at $20 or $1,200. So that means that you're willing to lose $12 or $1,200. Now, how do you actually execute that with as little risk as possible? Let me teach you how to do that. If you're willing to buy the company like SOXS, technically speaking, look at the May 19, 2023 expiry. The puts today that are basically saying that SOXS will continue to fall from 30 to about 20 is $8. Notice, somebody is willing to pay you $8 just to sell, just to be the last resort buyer. When you are selling the puts, sorry, if you sell the puts, then you're in the bid space here, you're getting $7.60. Now, assume that you post just $8 and it gets filled. When you sell a put at $8, that means that you are buying it at 22. And look at here as well. At 25, somebody's willing to pay you 4.6. Now you need to use your math. The reason why today's topic is mathematical concepts of lottery calls and put options is because you need to understand the math here. For options, number one thing you have to understand is what's the stock price today and what is your strike. Your strike price determines whether the put options would have value or not, or the call options would have value or not. Since this is a semiconductor bear, owning a bear is owning it through call options. Now take a look. If you believe that semiconductor shorts will go from 32 to about 40, what's the option pricing here? Here you can see that you need to pay as high as $7.70, which is pretty steep. We said 3%. If you're going to buy 3% of 40, that means 1.2. So basically, the call options is pretty out of reach for us. It's too expensive. That's why, if you'll notice, even if semiconductor SOXS only fell 3%, the call options here fell 20% because these call options are too expensive. So it's expensive that we expect these $8 to eventually go somewhere to about $1 to $2, no matter if SOXS just stays at 32. Why? As time goes by, it will decay, and as long as SOXS never hits 40 yet, then this time decay will eventually make the call options go down simply because of theta. Now, take a look as well here. Because this is an out of the money call, right? So this is actually very expensive in terms of the $8 pricing. If you really are bullish on SOXS, it's cheaper to simply buy the 30 calls here, which is just $10 with an intrinsic value of $2. Still expensive, right? So actually you're seeing that all of these call options are very expensive. So since all the calls are expensive, you want to check how about the puts. The puts is, there are two ways. When the yields are expensive, we always say sell the puts or sell the calls. In this case, since we are leaning bearish, the semiconductors, and we are leaning bearish, that means that we want to buy SOXS. We want to sell the puts here. So in this case, what you want to do is try to sell the 37.6 and you collect the premium. In this case, if you get something like $8 or $9, what it's simply saying to you is that you credit your account with $9, you receive $900 for the chance to buy SOXS at 21. Or if you're getting 8, then 30 minus 8, you're buying it at 22 rather than 32. So actually, if you think about it, that is such a discount. The market in the inverse funds today are so lopsided towards everyone just betting on the short side that it's extremely in favor of those who are willing to sell a put on SOXS. So looking at expiry, you have to understand where is the yield mostly being paid for. Is it on the calls or on the puts? In this case, you're seeing that everyone is basically paying so much on the SOXS calls, right? They're paying so much on the calls and the puts. Both are expensive that it doesn't make sense to buy. In this case, it makes sense to sell. And when you sell a call or sell a put, you receive those premiums. In this case, we want to receive premiums. So you're selling the puts for 30 here, either 30 strike or 25 strike. So just bear with me. Let me explain to you the NVIDIA trade here. For the NVIDIA trade here, what makes sense here? The current price of NVIDIA is 165, and we want to explain to you the differences between expiry dates. Here you have a 21-day expiry, and here you have a 147-day expiry. Now, it's important for you to define the expiry risk. If you believe that NVIDIA will fall, but you aren't sure when it will fall, take note. If it's 21 days, the put options will fall drastically. Even if NVIDIA only rose 3%, NVIDIA puts fell 30% here. Meaning, you would lose if this was $6, 6 minus 30%, you would have lost $180 immediately with just 1 day of NVIDIA going up 3%. Why? Because it's 21-day expiry. Time is ticking, and usually 45 days or less, especially 21 days to 0-day expiry, if your put options does not even fall from 165 to 160, this will crater very, very fast to zero. And why is that the case? Because a 160 put is unnecessary for anyone to buy when they can just sell NVIDIA shares at 165. When you're purchasing an out of the money put, it will drastically decay. This is what we're talking about. It will drastically decay. Now, say for instance, it's 147 day. Take note, NVIDIA also rose 3%, but the 160 only fell 10%. Even the 150 only fell 10%. So notice that there's a huge difference with the expiry date. The closer you are upon expiry, the faster the decay of out of the money puts, right? These are out of the money puts, and the faster the increase on out of the money calls. Because automatically for just with 21 days, these 160 calls where nobody wanted to pay for immediately rose 30% and the puts fell 30%. So notice that the closer you are to expiry, the more it becomes gambling, right? That's why a lot of people who purchase calls and puts out of the money with a 21-day expiry or 40-day expiry, 30-day expiry usually loses money. 99% of the people who buys calls or buys puts with an expiry date of this usually loses money if it's an out of the money type of option. Now take a look at this, the difference. If you want to short the company, this is 165, we argue that we want to pay only 3% yield, right? So what is 3% of 165? That would be $5. So even at current levels, this is not 3% yield. We are still waiting for NVIDIA puts to go down in price because the puts today of NVIDIA on 165 is more than 10%. 10% is $16.50. This is $21, right? The at the money is more than 10%. Even the out of the money puts are also expensive. So you want to still wait for this to continue going down. How will it go down? Usually time decay. The faster, you just need to wait for time and Vega to fall or the prices to go up. But really, time decay will help you. Even if the prices go up 3% or 1% or just goes unchanged, the longer time from 147 days, even if you need to wait from 147 days to 100 days expiry, over time, these prices will go down. We know that it will go down, that it will make sense for you to buy it when it becomes $4. That's one of the reasons why others would sell puts when it is very high price today. Now, wrap up. Let's talk about events. We said that the best way to make a put option or a call option is there needs to be an event. So one event that you might want to take advantage upon is China's tightening COVID-19 is curbs fuel pushback. So you're seeing that frustration is simmering in China among residents and business groups about the stricter COVID-19 control. So basically, Chinese stocks are falling yet again because of the COVID-19. Now, it seems that Hong Kong, the Chinese shares are getting faded as well in HSI a while ago. So you have the backdrop, the Chinese shares went up but are getting faded after a 25% rally and after that news. You could see that Hang Seng Index has rallied from 14,600 to 18,000, which gives you a short idea, meaning from an edge of long or short, you have the shorts actually in play with your 200-day and 100-day moving averages also on the primary sell side. So when you have the overall Chinese theme on the sell side, you want to check on Chinese companies that are near their resistances. One of them is Pinduoduo, which is currently trading here at about $70, $66. It's very near their 5-7 actually 12-month resistance, which has been retested quintuple times here at $70. Okay. Also take note on other e-commerce names like JD. You're seeing that a lot of e-commerce names are slowing down, and you can see that big downtrend on JD happening as well. So another thing to watch out in China is a lot of Chinese properties have been crashing and people haven't been paying their mortgages there. So you're seeing actually KE Holdings also going down with a primary downtrend to speak of. So after rallying 70% for Becky, you want to actually take a look on how to execute put options here. So for Pinduoduo, take a look. The 56-day expiry, $66. What is the, even if the price was unchanged, take note that as time goes by, the put options are declining, but not necessarily as big. 4% down, 6% down, 6% down, 3% down for the January 2023. At the same time, take a look at the sell calls. So the sell calls means that the people who are buying 75, they're still paying $4 for an out of the money call. Now, technically speaking, $4 isn't a lot, except that $4 is actually more than 5% yield. So somebody's willing to pay you 5% just to wait for 56 days in order for the $75 calls to expire to zero. Now, since this is an out of the money call, somebody's willing to buy Pinduoduo at 75 and pays you 4.7, what should you do? The choice here, since we are selling the shares, is that we should sell calls, receive this premium of 4.7, and then look at how much we could buy the put options for January 20. Notice that the 55 put option is $2.74. So that's actually more than 3%. So you want to wait for the 55 to be 1.65. You want to buy only 3% yield, or you take a look at the $50. The $50 here, the 3% is 1.65, right? So here you're already seeing that you can actually sell a call 4.7 and buy a put 1.65. Take note as well that even if Pinduoduo was unchanged, the put options here weren't falling as much, meaning you could buy at 1.65, 1.5, 1.4, but it's not being given to you at such a low price. Even the 45 puts aren't moving much anymore at 95 cents. Whenever I see that the stock price is not moving up, and the stock and the options aren't also drastically moving in a crazy manner, you tend to get an equilibrium where you can already see that somebody's already willing to pay for the 45 and 50 puts. So for instance, if you want to shell out $165, this means that you are paying 1.65, pasok siya dun sa 3% rule. Of course, if you can buy just $1, that's also good. Here at 45, you're also seeing that this is 2% yield, right, at 90 cents. So you can actually choose whether you want to buy the 45 puts or 50 puts. These two both are in our criteria. And then, of course, now obviously the stock price may not fall down very soon, but you can already take a claim on the yields today at 4.7 or 6.26. Both of these are also attractive. So you can actually do sell calls on 75 and 70 while buying puts on 50 and 45. Those are attractive ways to handle a short on Pinduoduo. Another example of a lottery trade that retailers have engaged upon today are the following things. Let me explain to you what's happening on Walmart. So the current price of Walmart is actually 152. You'll notice that 1 day to expiry, a put option at $150, say 1% drop, is 4 centavos. So why do you think that a lot of people have a lottery mentality here? If they buy 10 put options at 150 on November 25, they could potentially lose $40. However, if Walmart collapses just 149.9 on Friday after the Walmart shooting incident, for instance, because of the Walmart shooting incident, let's say people suddenly think that, all right, I need to possibly not shop in Walmart and possibly go elsewhere. I know that's such a ludicrous thing to think. thing to think. But let's assume that there are people who might actually assume that Walmart will fall down because of that incident. You may actually take a look at the following things. A 1 day or 2 day expiry usually would have a very drastic decay in puts. As you can see, 80%, 80%, 75%, etc. So a lot of times, people would assume that nobody's gonna buy a 150 put. All the people who are buying the 150 put are lottery players. So they're engaging in buying 4 cents for the reason that if they pay 4 cents, even if it goes to zero, their loss is defined at $40. So his 4 cents can potentially go 10 cents, wherein his $40 hits $100 if Walmart goes 149.9, because this is a 150 put. So what's the chance that 152.42 goes 149.9? Also, what happens if Walmart goes 149? Automatically, the 150 put becomes $1. So your $40 risk becomes $1,000 gain. So because of these outsized type of gains, from 40 to 100, you have a 250% return, and 40 to 1,000, that's like 25x return. You can understand with these type of payoffs why retail traders wants to play with the 1 day lottery options, even if the options will decay 80%, 90% on that day, in case Walmart doesn't go from 152 all the way to 150, 149, etc. Because these are what we call out of the money puts. Now, at the same time, let's take a look at a few logic cases here for Coinbase calls. So why are we taking a look at the Coinbase example? Because we've learned from 2 days ago that Bloomer has a stake in Silvergate, triggering a squeeze. He bought from 9% to 13% of all the Silvergate, knowing that Silvergate Capital is currently embroiled in a crypto related risk with FTX collapse. Take note that Coinbase, just as an indirect play of crypto, went up 5% on account of that news. Now, we know that Coinbase calls are going to expire tonight, actually, because I tweeted this November 24, which is 25 today. What happens if you want to spend $130 for this? Last night, Coinbase closed at 45.50. Take note that November 24 was a Thanksgiving holiday, so the only recent price action that we can see is November 23. Now, at $45, let's understand the options here. Wait here. For the call options, wait, for Coinbase, I have a bigger picture on the Coinbase here. Okay, let's discuss the Coinbase trades here. For the Coinbase trade, the event that we know is that there's a squeeze currently in crypto, spurred by the obvious reason of bullish bets on Silvergate. The event is somebody bought 1,000 December 40 calls at 35 cents for Silvergate, even if Silvergate during that time was just $25. Now you could see that Silvergate is soaring on Bloomer's stake, which is the Block 1 founder, taking a 9% stake. This is your Coinbase calls as of November 23. Now let's assume that we want to assume that by next week, Coinbase would trigger a squeeze the same way because Silvergate, crypto, etc. Although we assume that it will just be a 1 week squeeze or 3 day squeeze or 5 day squeeze. Now the 9 day expiry calls on buy order for Coinbase for 46 is $2.75, or the at the money is about $2.80 or $2.93. So let's say you shell out $2.93. That means you're going to take the risk of paying $293 for this company to go up to as much as $48.50 or above, since you are spending $3, right? Take note as well that there are several ways for you to also consider a long. Let's assume that you think that Coinbase within the next week, most of these 45 puts are all going to be gone. So you can actually already sell all of these puts, getting 2.6, 2.3, 2.1, and 2, knowing that potentially Coinbase puts 45 below will not make will be zero, or will basically decay 80% in 1 week's time. So since it's nearing expiry, the best way to actually trade Coinbase is to sell the put. Why? Because 90% of the time, these put options will go down and decay. So that's the highest probability trade, to sell the Coinbase puts. However, when you want to buy call options, it doesn't also it's not so bad, but you can see that although the call option, some people are already buying ahead, they're actually paying, look at the premium at 2.66 and 46, they're willing to pay 5% for it, no? So it's not exactly too expensive, but 5% of 46 means that Coinbase has to go above 48.60 or above 5% yet again, just for them to break even. So from this look only on the setup, the better trade is actually to sell puts on Coinbase. Now, let's show to you why people are also getting enamored with the 2-day expiry options. Let's explain to that. So Silvergate, after the stake event of Block 1 buying, went up 11%. Take note that because of that move, all of the 28 below puts have expired zeros, right? 80% down, 80%. And most of these might actually decay to zero. Take note as well that most of the calls went from nothing to 200, 500% up. So when the call options are very, very cheap, it does make sense sometimes to make a bet, especially if it's like 1% or less, right? Especially if you have an event like this. So here for Coinbase, let's also look at the setup. Take note that Coinbase setup hit near an all-time low of $40 due to the FTX collapse. And the reason why we want to initiate a trade play here on Coinbase to sell puts at 45 is because, number one, take a look at the yields. The 45 puts on Coinbase gives you 2.8 yield. So that 2.6, that's 5% yield being given to you, meaning your actual cost is 42.50. At the same time, one of the reasons why, if you don't want to engage in 9-day puts, 9-day sell puts, you might want to actually take a look at the 56 days. You are already being paid $9, which we believe is a very high premium if you're selling puts on Coinbase. $9 versus 45, somebody's willing to pay you 20% or a cushion of 20%, meaning your real cost is just $36 to make a sell put on 45. So this is actually very good. How about 30? Somebody here is willing to pay you as much as $5. So this is $30 cost on you for Coinbase, or $36. So Coinbase has to fall dramatically within the next 84 days for you to really be at a loss here on the sell put side of the 45 and the 35. At the same time, take a look at the risk that you will take if you buy a call option on the Coinbase here at about $60. Let's assume that, I know it might be very ridiculous to see Coinbase hitting $60 within the next 3 months. But let's assume that you believe that due to short squeezes, that Coinbase may actually attempt to hit 60 or 65. The cost to do that will only cost you at $4, well, that's still a little bit expensive. For over 60, it's about something in the realm of more than 5%, right? So you're paying 5% yield for the calls. Again, looking at the option space here, it means that it's really cheaper to do a sell put on Coinbase, both on the 9-day expiry or the 56-day expiry, which actually is the usual thing. Every call options player or put options player knows that selling puts or selling calls is the better play. In fact, a lot of studies have already said that writing calls and writing puts always makes more money 90% of the time because of the time decay, or theta decay and vega decay, because they're always overpriced to begin with. So this is actually overpriced in terms of puts. Think about it that way. Now, take a look as well, even on the 7-day. For the 7-day put options of Coinbase, people are paying $2.80, no? So even if you're not exactly very bullish on Coinbase, the fact that you're getting paid $2.80, $2.60 gives you all the reason to buy Coinbase here at 45, not unless you think that tomorrow Coinbase or next week goes down $20 or $30. So unless you think that Coinbase is gonna collapse, then the sell puts today are giving you such a great yield, right? So, and why do we think Coinbase is not going to go bankrupt? Because Binance and Coinbase here have a trust score of 10, and the reserve data is already available. You can already check all the Bitcoins and all the BUSDs that Binance and Coinbase actually have. So they're not actually going to be insolvent at any point in time, especially not next week and not in the next 3 months. So there's also something that you want to watch out for. Did the expansion of volume for Coinbase go up? And the answer is yes. Over the last 5 days, top stocks retail, number 5, Coinbase. Now, for Apple, you'll also see that there is an interesting dynamic to do for a trade. There's obviously a lot of Apple workers getting unrest at the China iPhone factory. In fact, I think 10 people even died. So more than 20,000 employees have reportedly left a key Apple supplier's main iPhone making plant, which is Foxconn in Changzhou, China, after getting unpaid dues. Basically, these workers weren't getting paid, they were overworked, and they weren't getting paid. So there's definitely a lot of problems in Apple, and you can even see insiders selling on Apple, on all the vice presidents, principal accounting officers, and take a look at the Apple chart here. You're getting them at resistances. So let's say that this is a high probability trade to shorten Apple. So how do we shorten Apple? Let's take a look at the expiry dates. This is Apple today. If you're looking at a 56-day expiry, there's several ways. In this case, since you want to short Apple, you take a look at shorting the call options here. Now, noticeably, even if you wanted to short the calls on Apple, it only pays you $2, which means that it doesn't give you as much of a yield to sell Apple calls, right? So there's not much incentive to get less than 1% yield for selling an Apple call. Now, however, take note at how much the put options of Apple could be within the next 2 months. You'll notice that the Apple puts here are declining 6%, $3 over 140. Now you saw Apple puts to actually be within the 3% yield that we want, but it's expiring about 2 months. So it's not like 6 months expiry to go. It's not like April or May or June, but this is decent enough. So you want to actually watch out for the 140 puts. You may be able to short Apple. In this case, this is $3 for your cost. Now, if it goes down 6% for the next 5 days, perhaps $3 could go $2. So what is your defined risk here? $3, $2, $1. How much you buy the put is going to be your risk or your insurance that you are paying for in case Apple collapses all the way below 140. Now, take a look as well on other expiry dates. Let's assume that you believe Apple will fall, but you don't know if it's going to take 56 days or 84 days or more than that. So we also evaluate what is the better option to do. Is it the $3 here or the $5 here for 140, same strike? Take note that for the 84 days, even if the 170 calls you wanted to sell, it still does not justify. It is too little yield. So you want to, since the call options here are, the calls are expensive, are very cheap, it doesn't make sense to sell them. When you see that the calls are not cheap, are very low, then you look at the puts if it's cheap enough. You'll notice that for an 84-day, the puts for 140 is $5, and even if it falls, it's only gonna go down 3%. So if you ask me, between 56 days and 84 days, I would prefer the 84 days because I may not be able to time the top perfectly for Apple, but for $5 risk here, the fact that it will decay slower rather than the 56 days, I may prefer to get this $5, or if I could get it at $3, even better. Take note as well for Apple puts at 147. You'll notice that this one collapses 3% when Apple is unchanged. Apple is unchanged here. This one also collapsed 3%, which means that even at $7 for 140 puts, this may actually be, it gives you all the time in the world to be correct, right? This is 147 days or more than 5 months versus 3 months. So sometimes paying a little bit of a premium still makes sense because you have all the time in the world to wait for Apple to fall down. So this is 5%, 7 over 140. And what is 5% of 140 here? It would be 7. So you're paying here less than 5%. This is actually nearing 3%. So here, if this goes about 4.2, it will pass our test. Same as this if it falls further and further lower. So you really just want to wait for the puts to become very cheap to get all the probabilities in your favor. In fact, I said that NASDAQ and SPY was rallying, but the market was not really buying it. If you read the options tape, Apple puts, which I tried to buy, would not even budge. Add the fact that there's insider selling, the market cap at 2.5 trillion when it is rotten inside. So let your stop loss be your option cost. Now let's look as well for more examples that we can initiate put options or sell calls. Retailers are sitting on record high inventories. You've got too many computers on hand, Nike, Gap, these are companies with risks. All right, take a look at the inventory of Nike. As of 2021 to 2022, the inventory just keeps on piling up. And that's in millions of dollars, $9.6 billion still not being sold for Nike. So these are also some examples of companies that are in the consumer discretionary spending that have been showing an increase in inventory. Nike, Crocs, Gap, Dell, Target, Dollar Tree, Walmart, Li-Ning, Anta, Skechers. So let's take a look at the charts of these companies. You've seen that there's a massive inventory buildup, and you can see that Nike is in a downtrend below 200-day moving average, which makes your shorts, okay, high probability. You can see also Nike here at yun. So this is the bigger picture, and this is the more zoom out picture, zoom in picture. So you can see that there's a lot of people who are gonna try to short Nike here at 112. At the same time, if you look at free cash flows, notice that among the durables, Nike has been slowly going down in terms of free cash flows, down 40% here, same as Estee Lauder, down 40%, with a PE ratio of Nike at 30 times and a PE ratio for Estee Lauder at 37 times. Now, you'll notice that the other brands are also expensive. Colgate is also quite expensive. So there's actually a reason to maybe short them both on the PE ratio, free cash flow ratio, and the fact that year-to-date, Nike and Estee Lauder are already down 30% tells us that there are so much reason for them to have meet their resistance. So they're actually in a selling mode, both on the 200-day moving average for Nike. So you're waiting for Nike, which is 106, to hit 113. It's near the resistance, same as for Estee Lauder, for a sell move. So this is an example of what we want to sell. Okay, so look at the 21 days. Even if you want to sell Nike, if you are wrong on the expiry date, you could lose 20% immediately. This is the reason why we caution people who want to risk $100 not to choose expiry dates that are very, very near the expiry. Because even if Nike goes down 100, but it doesn't happen within 21 days, your $100 here will automatically be gone. It will go zero. So will we take this 21-day expiry? The answer is no. Now take a look at the 84-day expiry. Here you can see that even if the stock was unchanged, the put options is down 11%. Now $5 versus 100 is 5% yield. We're waiting for this to go 3% yield, $3. So we're still waiting for this 5 to go down to 3. And we're also taking a look at whether does it make sense to sell calls on Nike. Here at $1.25, it's not really such a big yield. It's just 1%. So no, we don't want to sell calls. And do we want to buy puts? The answer is also a no. We need to wait for Nike put options to go from 5 to 3 or less. Now take a look at the 147-day. Now this is interesting. Take note that the 147-day or about 5 months, if you want to sell Nike calls at $120, you get $5. So that's about 3%, 4% yield. It's better than 1%, but 4% yield. Now, how about this? It's $7 to buy a Nike put option. It is not cheap, but we need to wait. Over time, if after 7 days, if this $7 collapses, say to about $5 or $3, then we have a deal. So you can see that as time goes by, as long as Nike continues to go up and up or above 100, these options or the puts will decay. The sell puts will continually decay to the point that the $7 will become $5, $4, where we want to buy it eventually. So we're waiting. Now, this is your leaning. It's in a downtrend. This is your Anta Sports in a downtrend. This is why we want to look at the other sectors, because if we want to short Nike, it gives us more conviction that we are correct, that we want to short Nike, but we simply need to wait for these put options to really fall down in price. So you really need to have patience to short Nike, because you don't have you don't have it cheap yet. Now, sometimes at $7, others will already be willing to buy at 7 because they assume that what if the S&P 500 collapses next week already because of Apple going down? Then they are assuming that because that happens, Nike will already fall from 106 to 105 or 104, that they cannot buy these puts at any cheaper level. To be honest, 3% may be too barat, too cheap. You may want to actually wait for about 5%. In general, sometimes even at 5%, I'm willing to buy Nike puts if I find all the probabilities already stacked up for the bears or for the shorts on it. So this is your sector and consumer discretionary. This is another idea that I want to pitch for you. This is Gap. You can see that Gap has rallied from 8 nearing 15, and it's nearing 100% move. So anyone who's been buying Gap would have been seeing that not only does Gap have negative cash flows, it's also got debt. So, and it also has been part of the consumer discretionary where the spending is not going to be recurring all year long. Okay, so now that it's near 16, this is looking to be a good short setup. Look at Skechers as well, nearing 43, which is near the 7-year, 8-year high, near the 8-year highs. Crocs is also near that resistance point at 105. And so we want to check each of these discretionary spending, which are near their resistance, how much are their options? Okay. So usually what I do is I take a look at the out of the money puts, but I wait for about 6 months, 5 months, 4 months to gauge how much the put options can go down in price so that I can buy it as cheap as I can. In this case, June 16, 2023, take a look at the 90 puts or the 80 puts. Here, it's still 10% above, so we're still waiting for Crocs to go, for the puts to go down. So eventually, we're still waiting. So usually, even if Crocs will just go unchanged, even if it doesn't go up, if it's just creeping up from 96 to 100, you just need to wait for the time to decay for these put options when you can buy the Crocs puts. Now, this is your Dell, also near the resistance, a lot of inventories, a lot of computers on hand. Take a look at the April 21 here. Take note that despite the fact that it's 147 days, we've seen that you can buy the put options of Dell for just $2 here and $1.67. Now, this is interesting because usually you don't see 30-40% declines on put options that are this far off. This is 147 days. This is like seeing Apple have a put option decay of 40% down. So usually what I want you to do when you're seeing put options collapse like this is to take advantage of that puts. So Dell, if you can get it here at $1.67, notice that 3% of 37.5 is somewhere in the zone of $1.20. So the nearer you are at $100, if this one goes 1, then this is going to be very interesting to take a look at on a buying side of the puts for Dell. So this is Dell. It's near resistance here at 45. That's why we want to buy the put options because we have so much time to wait, right? We have so much time to wait for Dell to go down from 45 to 40, and yet we're just paying $1, $2. So you can clearly see from my examples which are the options that we want to take in and which we want to have to wait for. Now, for Coinbase, as I said, the short case on Coinbase doesn't make sense because Coinbase does not have or very minimal exposure to FTX collapse. Coinbase clients are also likely to trust the exchange for reassuring that they are not scrupulous entities like FTX. Same thing with Binance, wherein if you're a Binance client, you're more likely to still be a Binance client over time. Usually, crypto falls and crypto exchange falls. With the FTX drop, Bitcoin drop, and Coinbase drop from $60 to $40, which means that you have the arbitrage point wherein if Bitcoin goes up, perhaps Coinbase goes up. Also, Coinbase has $5 billion in cash and it's at $12 billion market cap. So being the only exchange firm that is trusted right now for crypto in USA, it makes sense that for $7 billion, people will actually probably be more bullish on Coinbase rather than bearish. Also, so that's the reason why we're looking to sell puts on Coinbase. The reason why we don't want to buy call options for Coinbase is only because it is expensive. Had the call options on Coinbase become cheaper, then we may buy it. When I say cheaper, if I could buy cheap call options for 3% yield or less. Now, look for signs of cracks. Let's give you an example, financials. There's actually a free cash flow negative for Berkshire, free cash flow negative for Wells Fargo, free cash flow negative for Morgan Stanley, as well as drops on free cash flow for BlackRock. So let's assume that the most expensive on them, as you can see here, 20 times multiple for BlackRock. So among the financials, BlackRock seems to be the more at-risk play here. So here's BlackRock. You look at the chart of BlackRock, you're seeing that BlackRock rallied from 500 to 800. And more importantly, you're seeing a lot of insider selling from BlackRock executives as well. So there's a lot of insider selling here at 900, 800, 700. That makes us give the case that it's far above the 200-day. It's near that resistance point in year 2022. Plus, the business might actually go down given that many people might go away from asset management companies into cash. So this is your BlackRock. Let's take a look at whether it's cheap relative to the price. Now, when we say 3%, the 700 has to be $21. Right now, it's still 54. So we're still waiting for this to go down in price. So we're still waiting for BlackRock puts to become cheaper for the 6-month option. So for the June 16. So far, it's still expensive to short BlackRock through puts. But these are also the sales. So you can see that a lot of the insiders are selling. Larry Fink, November 22, sold $30 million. This is Larry Fink selling $30 million on August. So every peak, August and November, Larry Fink, which is the chairman and CEO, is selling, as well as last year, December, $15 million. So we're seeing actually that the insiders are dumping their shares. Now, let's assume that you want to go long. The very best way to find a long idea is you have to see cash flows go up, the PEs to be very low, and the year-to-date performance to help you at least in the price performance. So obviously, this year, the best sector is energy. You can see that the stock is also above the 3 months, above 50-day, 100-day, 200-day. That helps you understand that it is a company that is getting free cash flows, buybacks, and is still trading in a relatively cheap multiple. So here you can clearly see that amongst them, they're all actually energy names. You're just really waiting for the price to hit this 200-day if you're entering to make your buy point. So for ExxonMobil, it's 113. You want to wait at $90. It's Chevron, you want to wait 160. For EOG, you want 120. For PXD, you want to wait 240. So since it's very far away from 200 days, so far, you're still on the sideline on energy, even if you want to go long, because you wait for it 20% lower at current prices. So that's, now there are more sectors that we love to short upon. An example would be the consumer discretionary dining out sector. But I don't think I have all the time in the world to basically narrate every idea for you. But I hope that you learned something today. To make I'll answer the question. Why did you sell all your positions in eToro? Actually, I have positions here in eToro. I'm actually shorting the market. Let me show. This is awesome 10x. So you can see that. Let me share my screen. So you can see that I am long Solana. I'm entering a little bit on the crypto, just $100. I'm shorting Alliance, which is an insurance firm. This is in leverage. So you can see that my stop losses are very far. I have a short on Goldman Sachs. I have a short on biotech through LabD. That means I'm long. I'm long SQQQ, which means I'm shorting the NASDAQ. I'm shorting financials by buying FAS. I'm also shorting FAS, which is a financial bull. So far, I'm still waiting for the banks to crash. And as for, you asked me about the Nikki Yu. On the Nikki Yu, yes, I have withdrawn a lot of my cash there and I haven't deployed yet. Usually kasi when I trade eToro, I trade it in leverage. So I usually just trade $1,000, $2,000. So, here, Nikki Yu, no? Ay, mali. Back. I have two accounts in eToro, the Nikki Yu and the Awesome 10X. For the Nikki Yu, yes, it's in cash. I've nag-withdraw ko dyan. So I'm actually still up in my eToro for about 20%. I withdrew more kasi usually, so yan yung nakita mo, portfolio zero, right? Tama ba? Yes, because if you look at my history, so year to date, na-stop out yung shorts ko, and nag-withdraw ko. Meaning, nagpasok ko ng $13,000, money out ko is about 15K. So, kahit i-out ko to, I'm up about $2,000. Actually, if you'll notice, yung $2,000 na gain ko rito, yun yung trade ko dun sa Awesome 10X. Why am I doing that? Usually talaga, what I do is, I trade small. So if I can just trade $1,000 to $2,000 and make $1,000 from it, why do I have to put a lot of money into my account? So madalas yan, tinuturo ko yan talaga na I only expose 1 to 2K even if, let's say, may $20,000 in the bank na naka-cash lang din. Well, actually, right now, your dollars can earn 3.3%. Idle balance can earn 3% in IBKR. So it makes sense that if I already am shorting through leverage in eToro, I don't need to put $5,000, $10,000, or $20,000 into eToro. That's the reason why you will see na bakit withdrawn cash yung sa eToro. Konti lang. Even sa IBKR, if I can like what my lesson today taught you, if I can short Apple for just $3, $5, $6, $4, why would I actually short thousands of dollars? I can short Apple for just $3, $5 through puts. Tinuro ko to you today. So the reason why I taught you how to enable put options and call options is because it teaches you that you do not need a lot of money to make a trade. In fact, the explanation is to explain the system to you, like sinabi ko nga. Now, you might want to actually do those lottery calls, di ba? Some people might want to buy $200 Coinbase calls today. Pero ako, I'd rather sell puts ka sa Coinbase. Mas maganda mag-sell put. Tinitingnan ko rin eh. Sometimes is it cheaper to buy the calls or sell puts? Or do both. Sometimes it's also okay to do both. Kasi Coinbase, sell put, bayad sa'yo $9. Ikaw yung babayaran. For those who aren't aware, sell puts, you collect the premium. If the puts are $9, you're getting that, no? Look at this. Let me share again, no? So the best trades that you can make from looking at the class, no, is some of the best ideas is, you can buy Dell. You can buy Dell puts that is April 21. Ito mahal, although I want to short Crocs, mahal pa, so must wait. Actually, Gap, chinek ko na yan, medyo mahal pa, so must wait. Nike, gusto ko i-short, pero must wait. No, must wait. Apple, look at this. So, may way to short Apple, di ba? If you have April 21, it's $7.50 here, or dito, $4.70. Actually, I've been looking to buy this one, the 130 puts of Apple. So, inintay ko lang yung $4 na yan na maging $3 kung mabili kong lower. But either way, if you can see that, maliit lang yung risk. So, there are really ideas that you want to do in your portfolio nowadays. Kung medyo complicated, guys, ulit-ulitin nyo lang panoorin yung video hanggang sa masanay kayo. at some point in time, masasanay ka lang talaga. Masasanay ka na to see na this option is expensive, that I'm better off selling puts. This option is too cheap, that I'm better off buying calls. If you're wondering why the S&P 500 continues to go up and up and up, it's because the put options are still so expensive. So ang ginagawa ng mga options traders, they're still selling puts. Nagsisell sila ng puts to collect the yield. And then, obviously, when they sell puts, that means that they are effectively buying the stock. Diba? Kasi masyadong mura yung, masyadong mahal yung put premium. There are times when, because the option premiums are so expensive, as an options player, hindi pa rin nila, it still doesn't make sense to buy the put. Kailangan nila i-sell the puts and sell the puts until mag-decay yung premiums, saka maging willing to buy the put. So yun, you can already see that one of the reason why the market continues to grind upwards, even if there's a lot of bearish news, I think partly it's because of the options positioning. The put options are still too expensive. I'm still seeing that there's leeway for the puts to go down, for put premiums to decay. So, yun. And in terms of ano yung isa-sell puts ko, looking at many stocks, I prefer to sell puts on Coinbase. Kasi yun yung may exact trade event that you can actually capitalize. Yung mga iba, hindi ko pa ma-sell puts. Kasi bababa pa yung mga retail. So I'd rather wait it out. I mean, I want to short it. Mahal nga lang yung Nike shorts. So I just wait. So I hope that helps. The financials are still expensive to initiate puts. BlackRock, di ba? I wanted to short BlackRock pero mahal. So nauna lang yung shorts ko sa eToro, pero sa IBKR, I'm still waiting then to short those companies through puts. For those who are shorting the market, patience lang. Because it may take 1 week, 2 weeks, 3 months, no? But if you can see, puts will decay very fast. Nagde-decay naman siya if it's 21 days or less. So right now, you're November 25. It's just 1 month before Christmas. Advance Merry Christmas for those, for everyone watching. I hope to see you guys still even in Christmas time. I'm still gonna be reporting my Free Friday classes naman. And for those who want to learn more about the markets, how to handle your accounts in global markets, do it yourself. Please do continue to watch and share the classes. I think a lot of the movement in the market is simply a matter of patience. Maganda ngayon, to recap everything I've said, sell put ka sa SOXS to get that $8 premium if you want, $8 to $10 premium if you wish. Sell puts on Coinbase, buy puts on Dell, buy puts on Apple if you wish, but prepare to buy more puts on Apple in case Apple keeps on going higher. Okay, so that's it. Merry Christmas in advance. Alam kong 1 month pa naman yon, pero thanks for watching and thanks for always listening the class. Bye.